Greetings, everyone. Today, we're going to be learning about how to take advantage of net unrealized appreciation, or NUA, treatment on your appreciated ExxonMobil stock held within the savings plan. My name is Kyle McLean, and I'm a partner and senior wealth manager here with Rame and Gorell Wealth Management. Net unrealized appreciation can be a complex topic, so if you or someone you know could benefit from this information or the other services that our firm offers, please reach out for a complimentary consultation with our team, where we will take a look at your financial situation to determine opportunities for optimization from an employer benefits, executive compensation, investment, tax, estate, and retirement planning perspective. Net unrealized appreciation, or NUA, is one of the most lucrative tax strategies available within the Internal Revenue Code. NUA allows ExxonMobil employees to decrease the tax bill on appreciated shares of company stock owned within the savings plan. In order to fully understand the benefits of this strategy, it is important to know what the distribution options are for ExxonMobil stock within the savings plan. The first option is to roll over the stock in the savings plan to an IRA and continue deferring taxes. This eliminates the ability of the NUA strategy, and normal distribution rules will apply for distributions taken from a Roth or traditional IRA account. The second option is to take a distribution directly from the savings plan and pay ordinary income taxes on the full amount. This also disqualifies an individual from taking advantage of NUA treatment. The third and final option is to utilize net unrealized appreciation treatment on the ExxonMobil stock and to move it from the savings plan into a brokerage account, allowing the employee to reap the favorable capital gains tax treatment on the appreciation or growth that has occurred. Let's take a look at how this actually works. First, an employee must be eligible for a distribution from their qualified plan, generally at retirement or age 59 and a half. The employee takes a lump sum distribution from the plan, distributing all assets from the plan during a 1-year period. The portion of the plan that is made up of mutual funds and other investments must be rolled to an IRA for further tax deferral. The highly appreciated ExxonMobil stock is then transferred to a brokerage account. At this time, the NUA rule is applied, and the employee will incur an ordinary income tax liability only on the cost basis or price paid for that ExxonMobil stock. The appreciation of the stock above its cost basis while in the 401k is not taxed at the higher ordinary income tax rate, but at the lower long-term capital gains rate, typically 15%, but in some instances as low as 0%. This could mean a potential tax savings of over 20%. To better understand the benefits of this strategy, let's put some numbers to it. We will assume that the value of ExxonMobil stock within the savings plan is $500,000. The cost basis, or price paid for this stock, is $75,000. If one rolled the entire amount to an IRA, they will owe nothing in taxes presently. However, when those dollars are eventually distributed, the employee would pay $120,000 in taxes, assuming a 24% marginal federal income tax rate. If instead this employee chose to utilize net unrealized appreciation treatment on these shares, they would pay ordinary income tax only on the cost basis at the time of distribution. This would total $18,000 in tax liability today. However, assuming a 15% long-term capital gains rate, the taxes paid on the net unrealized appreciation would be 15% of the gain, or $63,750. This brings the total tax liability to $81,750. In this example, the employee saved over $38,000 in taxes by utilizing NUA treatment. However, if the employee were to receive a 0% long-term capital gains rate through the advanced tax planning that our team of CPAs provide, this savings could jump to over $100,000. While this strategy can seem like an absolute win from a tax perspective, there are a few important factors to keep in mind. NUA only makes sense when an employee has very low cost basis ExxonMobil shares within the plan. It is not uncommon for Exxon employees to have these low basis shares due to a variety of stock splits over the years and the stock turmoil in 2020. Stock shares must transfer in kind to a taxable account. This means that the shares must not sell, but must move from the savings plan into the brokerage account without being liquidated. It is also important to take advantage of the NUA rule prior to a rollover. Once the retirement assets have been rolled over into an IRA from Voya, it is far too late to take advantage of the potential savings. Thanks again for spending some time with us today to learn about net unrealized appreciation treatment within the ExxonMobil Savings Plan. At Raymond Gorell Wealth Management, we provide advice on over $1 billion in client portfolios. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their ability to enjoy their lives both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.